So, Netflix just dropped its latest earnings, and if you just read the headlines, you'd think it was bad news. They screamed missed expectations. But a really fascinating analysis from BGVC tells a completely different story, one where the company has actually never been stronger. We're going to walk through their take to see what's really going on.
And this is the big puzzle, right? How can a company miss its earnings target, but then the stock rallies and a report like this one comes out calling it a strong buy? It just doesn't seem to add up. But unpacking this contradiction, well, that reveals a huge fundamental shift in what Netflix has become.
And here it is. This is the core thesis of the whole analysis. Netflix has finished its big transformation. For years, it was this classic growth stock, burning through cash just to get more and more subscribers. Well, those days are over. It's now a mature media empire. It has become a true cash cow. And understanding that one idea is the key to everything else.
All right, so let's dig into what this new identity really means. The BGVC report calls it a paradigm shift, and they say it's built on three pillars that completely change the way you should think about investing in Netflix. Okay, so their whole argument really boils down to these three things. First, and this is the big one, a huge structural explosion in what's called free cash flow. Second, you've got this massive, almost completely untapped potential in their new advertising business. And third, a recent stock split that's kind of reset the playing field for investors. Let's start with the most important one, the cash. For the longest time, Wall Street was obsessed with one thing, subscriber growth. How many new users did they add? But according to this analysis, that's old news. The single most important number for understanding the new Netflix is its free cash flow. We're officially in the era of Netflix, the money printing machine.
And what a machine it is. I mean, just look at this number, $9 billion. That's the staggering amount of free cash flow management is now guiding for this year. This isn't just a big number, it's a huge signal of the company's maturity. It means Netflix is now generating way more cash than it needs to just run the business and create new content.
So what exactly is free cash flow? Well, the simplest way to think about it is this. It's the actual cash profit left in the bank after paying for everything, all the operations, and yes, even the billions they spend on new shows and movies. For years, Netflix actually had negative FCF. They had to borrow money to fund their growth. Now, that whole equation has completely flipped.
Okay, so Netflix is now a cash printing machine. Great. But where does the next phase of growth come from? Well, the report points directly at the advertising business, and it frames it as this enormous, untapped gold mine. And to really get a sense of how big this could be, you just have to look at this comparison. Netflix's ad business is, let's be honest, just getting started. It's in its infancy. Meanwhile, a company like Amazon is already pulling in over $17 billion in ad revenue, not a year, but per quarter. It just shows you the incredible runway Netflix has ahead of it. All right, so if the business is so strong and there's this huge new growth driver, let's go back to that original question. What was all that noise about an earnings miss? It's time to decode what really happened, because the headlines definitely did not give you the full story. And here's the culprit. It turns out the whole thing came down to this, a one-time charge of $619 million. It was for a tax dispute in Brazil that's years old. The key here is that it's non-operating. It had absolutely nothing to do with how the actual business performed last quarter. It was basically just a backward-looking accounting issue. And this is where it gets really interesting. Look what happens when you just pull that one-time charge out of the equation. The reported operating margin was 28.2%, but if you adjust for the Brazil charge, the real core margin was a stunning 33.6%, way better than anyone expected. Same story with earnings per share. The reported number was a miss, but the adjusted number would have been a solid beat. This is the story the market actually saw. Okay, so now that we've decoded the earnings miss and we understand the new cash flow story, let's talk valuation. Let's look at why this report lands on a strong buy. And then, to keep things balanced, we'll finish up with the real risks that are on the road ahead. So you might look at this and think, whoa, Netflix looks way more expensive than Disney or Warner Bros. And you'd be right, it is. But there's a good reason for that premium. The BGVC report argues that Netflix has a purer growth story. It's all in on streaming. Meanwhile, the legacy guys like Disney are still dealing with the drag from their old, declining cable TV businesses. And one other thing that's kind of reset the board is that recent 10-for-1 stock split.
Now, to be clear, a split doesn't actually make the company any more valuable. But what it does do is bring the price of a single share way down. And that's a huge psychological thing. It makes the stock feel more accessible to everyday investors and boosts liquidity. But of course, it's not all smooth sailing, and the report is pretty clear about the risks. You've got macro issues like more digital taxes popping up or a strong dollar hurting international revenue. Competition is obviously fierce. You've got YouTube on one end and Amazon's whole Prime ecosystem on the other. And then there's a big internal challenge. They have to execute a tricky migration of their ad technology away from Microsoft. These are definitely things to watch.
And that really leaves us with the big question, doesn't it? The argument is that we're in an era where cash is king, and Netflix is finally generating tons of it. But the streaming wars aren't over. They're just changing. So the question is no longer just about who can grow subscribers the fastest. It's about whether Netflix's new financial moat is deep and wide enough to hold off all the new challengers coming for the crown.